This is the story of how Odyssey Marine Exploration Incorporated, or OMEX, a publicly traded shipwreck recovery company, sank. Though the company's only been around since 2004, their story starts about 150 years ago. In 1865, the SS Republic, a side-wheel steamer that had served for both the Union and Confederate navies during the U.S. Civil War, sank to the bottom of the Atlantic Ocean after battling a hurricane about 110 miles off the coast of Georgia, and with it sank precious cargo of gold and silver coins. There, the treasure laid undisturbed for nearly a century and a half until 2004, when OMEX discovered it and began an operation to recover its cargo. They first conducted a pre-disturbance survey, taking 4,600 still photographs over 23 dives to plan the recovery. Following that, 41,000 gold and silver coins and 14,000 artifacts were recovered over 262 dives. The company sold the cargo and by 2007 had earned $33 million in revenue from its most valuable coins alone. The SS Republic recovery was OMEX's most lucrative mission to date, and at the time set the foundation for this publicly traded company's conviction that it had a solid business model, roaming around the world in search of treasure. In addition to treasure hunting, OMEX also recovers minerals and takes on contracts for various public and private survey and exploration projects, using their deep-sea remotely operated vehicles. While this doesn't sound like the best business model, at the same time there couldn't be a more appropriate enterprise to take the corporate form. After all, corporations were created to mitigate risk of private investors. In a way, OMEX's business model harkens back to the early years of the corporation, risky endeavors that collectively people wanted to pursue but feared shouldering the risk individually. And this business certainly takes on a lot of risk. In fact, in its 10K, the company plainly states that the business involved a high degree of risk, expounding on all the various risk factors associated with it. First, the company cannot ensure that the data they are using to conduct a recovery operation is reliable, which may result in inefficiencies in operations, diving into the depths of an ocean, and coming up with nothing. There's also the risk that the excavation cost may exceed the value of the recovered cargo. Not only is there uncertainty about what cargo may be present or recoverable, but even when that is known, it is difficult to estimate its value until it hits the market. This is a point we'll return to later, as it is one of the key issues that led to the company's demise. Next, it requires engaging in complicated litigation to obtain environmental and legal permits to operate at any given site. Then there is the question of who owns the stuff. Is it the colonial power that the ship once sailed for? Is it the heir to the family who once owned the chest of artifacts? Hard to say. These are complicated questions that result in constant litigation. For example, in 2007, OMEX had to return 17 tons of silver from the recovered cargo of Spanish frigate Nuestra Señora de la Mercedes, as it was deemed unlawful. The Spanish government sued the company in America courts and won. OMEX was forced to transfer the treasure along with a $1 million fine back to Spain. These lawsuits have contributed to the company's tarnished reputation. Moreover, the company's founders had been accused by the SEC for allegedly insider trading when they were operating Seahawk, the shipwreck recovery company from which OMEX evolved. The report also mentions that the company could be delisted from NASDAQ because its share price once dropped below $1 in 2015. Moreover, if the company's total value drops below $35 million for more than 30 days, which it does in 2016, then it will be delisted. Last but not least is the risk of pirates. That's right, pirates. So given all these risks, let's look at how the company's doing. First, we'll take a look at the current ratio to get a sense of how liquid the company is. We can see a significant decrease in this ratio from 2014 to 2015, due in part to the company's unloading of assets. It sold all of its inventory, which is essentially recovered cargo, and did not take on as much value from accounts receivable, most likely due to having a slow year of cargo recovery. It seems that the cash from the accounts receivable collected in 2015 was used to pay off some of its liabilities, but because the company is so deeply in debt, which we will get to in a little bit, they had to take out another loan to stay operational. Also, a significant portion of their assets is in expensive machinery that depreciates relatively quickly at approximately $6 million per year. This also drives down the current ratio on paper, though it is likely that the value of the machinery is still intact, as they have been using the same ship and ROVs since 2004. So, the company is not very liquid. As we will see in the next slide, the company cannot earn a profit on its operations, and so it gets by year to year by taking on more and more debt from investors who are hoping the company gets lucky and strikes a big payload. Let's take a look at how profitable it is. Ooh, not looking good. What's going on here? Here we can see just how unprofitable their operations are. Even in 2013, when the company seems to have earned nearly 20 times the revenue from recovered cargo sales than it would in the next 2 years, its operating costs alone exceed the income by $2 million, leaving the company at a loss from operations of $17 million for that year. In 2014 and between 2014 and 2015, that loss widens. Their cost of operations and research and marketing, general and admin exceed their revenue by a significant amount. This gets at the core issue of why the business is failing. The cost of their deep sea exploration and recovery operation, litigation, and marketing of their services is just too high compared to the value of the cargo they recover. We can see the company started taking on losses in 2005 when operations and research went from $1 million to $11 million and then stayed above $10 million every year since. Similarly, marketing, general, and admin made a jump and rarely dipped below $9 million thereafter. As such, the company has suffered a loss every fiscal year since inception, except for 2004. Finding itself in severe debt, in 2015 the company switched business models. They realized the only way they can claw their way out is to win on a big bet, one that greatly exceeds their cost of operations and can recover their losses for the past 13 years of operation, which is about $220 million. In the meantime, it just needs to stay operational. This is what led to a change in its business model. In December 16, 2015, Omex sold its book of shipwrecks to an affiliate of Monaco Financial LLC, a rare coin dealer called Magellan Offshore Services, which was set up to compartmentalize and handle the relationship with Omex's shipwreck arm. In exchange, Magellan agreed to provide exclusive contracts to Omex, which would operate at cost-plus basis and get 21.25% of revenue from bounty recovered and sold. The only substantive break with the past is that under the new model, where previously it was the company's bottom line and Odyssey's long-suffering private investors who took the hit when nothing was found or Odyssey overreached itself legally and lost substantially in the courts, now it will be Magellan's investors who pay the bills for the marine diesel and, if necessary, the lawyers. Omex still retains the expensive machinery and expertise, but now is a for-hire contractor of exploration and recovery services, having abandoned shouldering all the risk of its independently financed missions. Selling assets also allows the company to offload some of its long-term debt. So, they offloaded a bunch of assets, namely their office building and some equipment furniture, cashed in on their accounts receivable, and at the end of the year have $18 million less in assets. We can see that reflected in the increase in debt-to-asset ratio. In 2014, that ratio is 1.41, and in 2015, that ratio is nearly quadrupled. Though they use some of that cash to pay off both short and long-term debts, they have to take on more debt to stay afloat. It took out more loans in 2015, resulting in a reduction of its total liabilities from 2014 by about 10%. So in summary, the company is highly leveraged by debt, and it needs to keep on taking debt to stay afloat. Last, let's take a look at its debt-to-equity ratio, which is negative because the value of the equity is below zero. This is actually the cause of its recent delisting from the New York Stock Exchange. The company's value dropped below $35 million sometime in 2015, and after trying to secure enough investment and rights to a critical mineral recovery project off the coast of Mexico fell through, the company was unable to raise its total value, resulting in its delisting from the public exchange. Due to the high risk, high reward nature of the business, it seems that the company keeps sinking further and further into debt, holding out for that one jackpot of a payoff. Typically, when companies have negative debt to equity ratios, they have a hard time obtaining loans from banks. However, Omex is an unconventional business, and there are adventure-seeking investors out there who continue to finance Omex through holding companies that similarly hope for a big payoff, which is exactly what the new business model is predicated on. Its last and great hope is the Don Diego mineral deposit off the coast of Mexico. Omex has been pursuing obtaining environmental approval from the Mexican Secretary of Environment and Natural Resources to dredge the sands of the tenement and extract phosphates, which are used in the production of agricultural fertilizer. They believe the total value of the recovered minerals could be around $2 billion, enough to bring the company out of debt and handsomely reward its investors. In March 2016, when the 10-K was submitted to the SEC, Omex remarks that the permit was pending. But a month later, in April, its application was denied by Mexican authorities on the grounds that it would be too disruptive to endangered sea tortoise habitats. The company issued a press release later expressing its disappointment. They continue to litigate, maintaining the argument that the ecological impact assessment Mexican authorities made was based on misinformation and that the proposed program to promote the habitat of the tortoises would offset the negative effects of their operations. As for now, it is not looking good for Omex, as it submitted its first application in 2014 and only heard the results in 2016. It could be another many years before their approval goes through, if at all. That said, it would only take one Don Diego to justify its otherwise financially disastrous enterprise and earn huge profits. Thank you.